Hello everyone and a warm welcome to the latest episode of Equity Market Outlook from Baroda BNP Paribas Mutual Fund. During the course of next few minutes, we would do a quick recap of the year gone by, discuss about key factors that we expect to be the key drivers for the market this year, take a look at the valuations, and finally talk about our fund positioning. Beginning of the year is always a good time to take stock of how things panned out in the previous year. 2023 was undoubtedly an eventful year for the market as we crossed the 20,000 mark on headline Nifty index. The year was far more eventful due to the strong outperformance of mid and small caps. While the headline Nifty index was up 20%, Nifty Mid Cap 150 index was up 44% and Nifty Small Cap 250 index was up 48%. However, you would be surprised to know that Nasdaq was one of the best performing major markets in 2023 with a return of 43%. Why these facts are important is because when we started the year 2023, there was a scenario of gloom and doom around the world. Experts were talking about a recession in the US and interest rates were going up globally. Interestingly enough, the US 10-year yield closed 2023 at the same level as 2022. Of course, the yields went up as high as 5% during the course of the year before falling back. And amongst all the global uncertainties, like the Indian markets, the US market also made a new high. This change of sentiment also resulted in net FII inflow in the equities of over $20 billion in calendar year 2023, compared to a net outflow of over $16 billion in the previous year. The key takeaway from all this is that we live in a very dynamic environment and things can change very fast. Hence, it is important to keep an open mind and to be nimble-footed. This brings us to the point as to what we believe would be the key factors to look out for in the current year. Year 2024 is expected to be a very interesting year as more than 50 countries that are home to half the world's population goes for national elections. Of course, this includes India and the United States, which are of particular interest to us. Any change in regime in some of the countries would have an impact on the terms of engagement, which could include trade as well. Second factor that we believe 2024 would witness is the onset of rate cut cycle. Jury is still out on the timing and the extent of such rate cuts. What one would be interested in is the new normal of inflation and hence the rates. This obviously has implication on rate-sensitive sectors such as consumer discretionary, real estate, and last but not the least, financials. Rate cuts in US may also signal revival of the discretionary exports to the US and other developed markets, particularly for segments like textiles and auto components. Lastly, from a global perspective, we can never take our eye off from the geopolitical development taking place across the globe. We would be keeping a close watch on energy prices as our North Star to take a call on this issue. Coming to the domestic front, of course, our base case scenario is the continuation of the current policy regimen, which would mean ongoing impetus on segments like affordable housing, infrastructure, green energy, and overall manufacturing. Two key factors that we would be looking out for are any signs of recovery in lower end of consumption ladder, which has been lagging in for a while, and recovery in private capex. While we see initial green shoots in both of them, we would be watching out for data points that confirm the same. Another important event from the financial markets perspective would be the inclusion of Indian bond in global bond indices. Indian bonds are slated to be included in JP Morgan's widely tracked Government Bond Index Emerging Markets in June of the current year. This may see an inflow of anywhere between $20 to 30 billion as per our various estimates. And of course, this could pave way for inclusion of Indian bonds in other global indices as well. This would have ramification for both liquidity and currency. We would be keenly watching out on how RBI decides to deal with this liquidity. In summary, we are factoring in an improving global growth outlook, higher liquidity scenario, and a stable domestic policy regime with impetus on investments. This brings us to the next discussion point on valuation. There has been a lot of debate around India's valuation being expensive than rest of the emerging market. When we say that India is trading at a premium to other emerging markets, we know that China has disproportionately higher weight in emerging market index. China has witnessed continuous derating in the past 3 years because of factors which are specific to that country. Hence, if one were to look at the premium of India's valuation vis-a-vis emerging market ex-China, the numbers would not look that staggering. But more importantly, we need to put this premium valuation in the context of factors like earnings growth, ROE, and depth of the market. India clearly stands out within the emerging market peers on all three accounts. We have already discussed about earnings growth. The ROE story is similar to earnings growth in the sense that corporate India has been consistently delivering double-digit ROE and has one of the highest ROE across the region. Lastly, India is now the fifth largest equity market globally in terms of market capitalization. We have more than 450 companies with an average market capitalization of over $1 billion. Such kind of width and depth is incomparable in any other emerging market. Now coming to India's valuation relative to its own history. First, valuation of about 20 times price to earning ratio on a 1-year forward basis is in line with the median valuation of the last 10 years. Secondly, this valuation has to be looked in the context of the fact that Indian corporate is actually operating at the highest ROE in the last 10 years. Thirdly, India and Indian markets of today is very different from 10 years ago. India is a $3 trillion US economy now and is ranked as the fifth largest economy of the world and is slated to be the third largest economy by end of the decade. From a market perspective, it is no longer dependent on foreign inflows and we are now getting close to $2 billion worth of SIP on a monthly basis. Given the fact that the characteristic and color of both the economy as well as the markets have undergone significant change, there is a case for current valuation to sustain, if not get further re-rated. Coming to the last section on how is the fund house positioned at this point of time. As a house, we continue to be favorably inclined towards the 3 C's: credit, consumption, and capex. Finalization of Indian consumers happening at a brisk clip, aided by factors like the mobile payment system, etc. We do keep evaluating the growth versus value trade-off between banks versus NBFC or insurance or other ancillary providers, but the segment is definitely of interest to us. Being a young growing market, consumption is a long-term winner in our view. At this point of time, we may have a preference towards urban consumption versus rural and certain service providers and discretionary items like auto versus traditional FMCG names, but the space is surely of great promise. Let me talk about the third C, capex. India is rapidly investing in its railroads, roads, and power network among other areas to sustain its growth momentum. Capital expenditure plays piggy banking on this theme is another area of interest to us. As a result, the entire value chain of construction, engineering services, equipment suppliers, including cement, could throw interesting investment opportunity. That will be all from our end for this episode. Stock called India has a strong growth story for the foreseeable future. Equity is one of the best ways to partake in this growth story. Happy investing.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.